Look, we've all been sold the dream of the stock market as this land of infinite opportunity. But behind the screens, away from what the average retail trader sees, there's a manufactured reality. So, in this explainer, we're going to forensically dissect the mechanics behind sudden small cap spikes and, frankly, the devastating hidden risks of derivatives. No fluff, no bluff. Just a realistic look at how market mechanics actually operate.
It almost always starts exactly like this. You're watching a completely unknown, low liquidity stock, and boom, it suddenly spikes 20% in a single trading session. There's no breaking news, no earnings report, just massive, unexplained green candles. Then, give it a week, and it's up 50%. And suddenly, it's everywhere. Telegram groups, social media influencers, retail forums, they're all aggressively pushing the ticker, practically guaranteeing it's the next big multi-bagger. The narrative is seeded, right? And that hype train really starts to accelerate. Before you know it, the stock has skyrocketed 200%. The charts go completely parabolic. And this right here is the psychological trap. Thousands of retail investors, totally blinded by the fear of missing out and those flashy screenshots of fast money, just aggressively buy right into this manufactured momentum. But if you actually want to survive in this market, you have to ask yourself a critical question. Who initiated this massive buying spree before the public even knew this ticker existed? And, honestly, more importantly, who is mathematically destined to be left holding the bag when this artificial momentum inevitably breaks and the price crashes? Because in certain, darker corners of the market, price action is heavily dictated by large, coordinated players. So here is what we are covering today. 1. Who are the operators? 2. The pump and dump cycle. 3. The derivative manipulation trap. 4. The dangers of single stock options. And 5. Exactly how to protect yourself. All right, part 1. Who are the operators? The harsh reality is that not all price action is organic. It's not always driven by a company's actual financial performance. Very often, it is entirely manufactured by what we call operators. We're talking about high capital syndicates or massive institutional whales who strategically coordinate to artificially control the supply and demand of a specific stock, and they do it purely to their own advantage. These operators are incredibly tactical. They specifically target low liquidity, low float environments. Why? Because when a stock's active daily trading volume is practically dead, even a relatively small, targeted injection of capital can violently force the price upward. They literally engineer the breakout. Then they weaponize the resulting rumors and totally exploit the predictability of retail herd mentality. Which brings us to section 2, the pump and dump cycle. Let's break down the actual anatomy of this trap because it operates in 4 very distinct phases. Phase 1 is quiet accumulation. Operators quietly hoard shares when volume is just completely dead. Phase 2, that's the engineered breakout and that coordinated social media hype we just talked about. By phase 3, retail greed peaks. This provides massive liquidity as everyday investors rush in. And then phase 4, the dump. Operators ruthlessly offload their inventory straight into that retail buying frenzy, triggering a sudden, devastating crash. Now let's get into the really insidious part. Section 3, the derivative manipulation trap. You see, the manipulation in the cash market, that's just the tip of the iceberg. Hidden beneath the surface, over in the derivatives market, these operators are building massive, highly leveraged bearish positions. They are quietly loading up on put options or short futures in the exact same stock they're currently pumping. They do this because they fully anticipate the impending crash that they themselves are about to execute. So think about how this plays out. When the operators finally execute the dump, the violent downward panic creates insane volatility. Now, even if they just break even or maybe even take a slight loss offloading their physical shares in the cash market, the massive leverage from their hidden derivative positions yields a catastrophic exponential profit. They're using the cash market just to manipulate the price, but the derivatives market, that is where the real wealth is violently extracted. This leads us right into section 4, dangers of single stock options. If we compare index options to single stock options side by side, it reveals a pretty grim reality. While indices boast high liquidity and are extraordinarily difficult for a single syndicate to manipulate, single stock options suffer from a dangerously low lack of liquidity. Because of this, they are highly susceptible to operator-driven, totally unpredictable gap ups and gap downs. And here's where beginners really get hurt. Retail traders often buy these cheap, out-of-the-money, single-stock options, basically chasing a lottery win, while being completely blind to the hidden mechanics of option pricing. They face theta decay, which literally melts the premium away daily. Then there's extreme implied volatility crush, where the premium violently collapses even if the stock moves in the right direction, simply because the hype vanished. Between the extreme leverage and the rapid time decay, these out-of-the-money retail premiums are mathematically designed to go straight to zero.
All right, final section. Section 5, how to protect yourself.
Defending your portfolio against these traps requires absolutely clinical discipline. First, ignore the noise. Cut out those blind tips from Telegram groups and social media entirely. Second, verify the actual business fundamentals and cash flow rather than just chasing manufactured momentum. Third, completely avoid derivatives until you fully master the mechanics of options pricing and leverage. And finally, strict risk management and position sizing are absolutely non-negotiable.
Listen, if a move in the market looks too fast, too hyped, or just too easy, it is almost certainly a manufactured trap. Your primary rule has to be protect your capital first, profits come later. So the next time you're watching a parabolic small cap stock light up your screen, you really have to stop and ask yourself, are you truly catching a breakout, or are you just providing the exit liquidity for the operators? Think about it.